It's time for the Brian Beatty Real Estate Show.
Good morning, Charleston, and welcome to the last show of the Brian Beatty Real Estate Show here in 2025. What a wild ride this year has been. We are going to talk today about what we think is going to happen next year in the world of real estate. What's going to happen in housing nationally, regionally, locally. How does it impact us here in the Low Country? So we've got a lot of information to share with you on my thoughts and opinions on where this market is headed. Everybody this time of year is asking me what they think will happen next year. And so this is the show where we lay it all out on the table. And I've been selling real estate here for, 20 years. I've sold about 1,500 properties, about $1 billion worth of real estate represented in that time. So I'm going to share my thoughts and opinions on the market as somebody that has been in it, not just from a real estate practitioner's perspective. I'm also an investor. I also own a property management company and a private money lending company. I own rentals. I flip. We buy and sell land all over the state. So we've got a pretty unique opinion, I think, of the real estate market based on our experience. And I want to calm some nerves as well, because I think a lot of people are watching things on YouTube and maybe reading some things online where a lot of the folks that are putting out the content are really just after subscriptions. They're after views. They're after clicks. Maybe they're trying to get monetized. Who knows? But we've talked about this a lot on this program about all these claims being made about our market dropping 50% next year and prices about to just go way, way, way down really quickly. And here's what I think a lot of people are missing when they hear phrases like housing crash or next recession. You know, what's coming, in my opinion, isn't either of those things. What we're really headed toward starting, next year is what I'd like to call the great housing reset, right? And no, that doesn't necessarily mean that prices are suddenly going to fall off a cliff. It's not a quick correction, and it's not another 2008, all right? So instead, I think it's just going to be a slower, multi-year process where homes gradually pick back up and prices start acting more normal. The big shift is affordability, not because prices collapse, but because incomes finally start growing faster than home prices for the first substantiated stretch we've seen since the Great Recession era. And that's really one of the tales of the tape for what's going to happen next year. Now, let me be clear. This doesn't make housing, quote unquote, cheap. Right? Especially for Gen Z, young families just starting out. I mean, a lot of them are still going to have a tough time and make some tough trade-offs, living with roommates longer, moving back in with parents, delaying marriage, delaying kids, or, all of the above. And because this affordability issue is so widespread, you're going to see politicians on both sides of the aisle start throwing solutions at it. We've already started to see that. Right, anything from pro-building to, YIMBY-style policies to expanded manufactured housing, pressure to reduce interest rates, 50-year mortgages, privatizing Fannie Mae and Freddie Mac. I mean, I know that Trump obviously came out earlier in the week and, gave his address and alluded to the fact that there are some quote-unquote massive changes coming to the housing market, or at least from a policy perspective. And so I think that everything is more pro-building, right? None of them are a magic wand. This reset, in my mind, is not about instant relief. We're dealing with right now the issues that we have experienced as a real estate market as a result of the instant relief that was provided in the form of 3% and sub 3% interest rates, right? Which is what created this big lock-in effect, a lack of interest in putting their home on the market because they like their payment more than they like the idea of moving into a new home. Inventory isn't going up quickly enough. The market's just a little stalemated right now. So I don't think the reset is about instant relief at all. It's about slow structural change in our market, and understanding that difference, I think, is critical if you're thinking about buying, selling, or investing over the next few years. So we're going to get into a bunch of different predictions for what I think is going to happen in the real estate market next year, some of which are going to be market specific. Some of it is going to be industry specific. and some of the changes that we're seeing and experiencing. But you're going to walk away at the end of the show with a very clear understanding, at least I hope, of what to expect next year in our local real estate market. And we'll kind of take a little bit of a roundabout way to get there, but that's the goal. And so one thing I do want to mention is that a lot of people, obviously right now, people are with families, it's holidays, it's not really top of mind for many people to buy or sell a house, right? There are still plenty of people that are transacting. We've been doing deals all month. December is usually a busy month for us. I know a lot of people like to think that the market's dead during the holidays. It's not. Maybe it's just because we choose to work. I don't know. But there's still plenty of activity in the market right now. But I think a lot of people are gearing up for what's going to happen next year, and they're going to try and time when they think it's the appropriate time to sell and or buy or invest, fill in the blank, right? So this is the show that's going to help hopefully give you a roadmap, so to speak, or at least help you understand where the guardrails are, right? Now, if at any point in time you guys are like, I think it makes sense for me to just engage with the real estate agent to talk through my concerns, my plans, see if there's anything I'm missing. Last thing you want to do in a market like this is make a mistake, because mistakes in real estate are extremely costly. And so if you're thinking of buying or selling or investing, or maybe you have a property that you have been self-managing and you want to get a property manager involved, we can help with all those things. Maybe you have land that you want to buy or sell or develop or build on. Or maybe you need access to short-term capital for an investment project. We can help with all those things. If you want to reach out to me, my phone number is 843-800-0065. That's 843-800-0065. Or you can go to our website, listingsincharleston.com. That's listingsincharleston.com. Of course, just as a quick reminder too, anytime I'm here in the studio, I record myself. We put those videos on YouTube. So if you ever want to just watch rather than hear, check out what we have on YouTube. And, if you'd like, you can also get our podcast on iTunes and Spotify and Google Play and iHeartRadio too, I think. Just search the Brian Beatty team and you'll find us in a variety of ways. So let's get right into it, right? Enough leading up to this. Let's get right into it. The first prediction, which everybody wants to know about, right? Which is why it's first and number one on the list, is interest rates. What is going to happen with interest rates, right? I know that, like as an example, Trump wants a changing of the guard. The chair of the Federal Reserve, he's hoping for much lower interest rates. I don't know if we'll be able to get there or not. I'm not sure. If you look across the board at predictions from folks that are smarter than I am in the world of economics, a lot of people are saying that we should expect to continue to see mortgage rates with a 6 in front of them next year for a majority of the year. Fannie Mae, as an example, is predicting 5.9% by the end of next year. You've got folks like Redfin that are saying that it's probably going to be more like 6.3% on average next year. But I think that mortgage rates gradually will decline next year. One thing that I personally am not a huge fan of are these sharp increases and sharp declines that create moments of frenzy, right? You had so many folks, just as a quick aside, that weren't really thinking about buying or selling a house, but the environment incentivized them to go ahead and buy a house now. They're looking at their current home and they're at like a 5.5%, 6.5% interest rate. And they're saying, wait a minute, I could sell this house with the equity that I have in it, and I can literally transition to a bigger, better home and still pay less per month. Why not? Right? So that was the mentality for a lot of people is, well, why not do this now? Assuming you could actually find a house that you wanted because there was next to nothing for sale, which is what created bidding wars and blah, 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 blah. Cheap money. People didn't care so much about the price they paid. They just wanted to get a really good interest rate. And so you won against the bank, not necessarily against homeowners. Well, obviously, we packed a bunch of transactions that might have been 2, 3, 5 years down the road into like a 2-year period. And it just created massive market appreciation. It created even more shortage. And now we're kind of left with the burn off from that. And so what's most likely to push rates down, in my mind, isn't some big economic collapse. It's just it's a cooling labor market, right? As hiring slows, as the job market loses a little steam, the Fed will probably start cutting rates next year and move monetary policy kind of back to something a little more neutral. And when that happens, mortgage rates should settle into the low 6% range is what everybody's kind of saying, which honestly might feel like a relief compared to what we've been living with rates in the 7s and at points in time 8. And in the grand scheme of things, 6% isn't that bad of an interest rate. But here's the part that people need to understand. Inflation isn't gone, right? And if we manage to avoid a recession, the Fed, I mean, they're not going to get aggressive with cuts. I mean, they're not going to slash rates the way people are hoping, right? The idea that by this time next year we're in an environment where rates have a 4 in front of it, I don't see it happening. That's why, I mean, you might see mortgage rates dip below 6% here and there, but it's probably going to not stick for any meaningful length of time. And, I know what people are saying, well, the Fed gets new leadership next year and, won't that change everything? I mean, really, probably not. We'd like for it to. I mean, everybody wants a lower interest rate. There's no person out there that doesn't want a lower interest rate. But, mortgage rates aren't set by the Fed directly, right? They're set by the bond markets. And as long as investors see inflation as a lingering risk, long-term rates like mortgages aren't going to fall dramatically. So the takeaway here isn't wait for the 4% again. It's understanding where the new normal likely lives and planning around that reality instead of just hoping for a return to the past. So we're going to take a quick break. When we come back, we're going to talk about how that is going to impact affordability as wages, for maybe the first time in a very, very long time, the increase in wages actually outpaces the increase in the cost of home ownership. So we'll talk more about that when we return. But again, if you want to reach out to me, you want to talk with somebody that really understands this market, that is an expert in this market, that's done 1,500 transactions, that still represents everyday buyers and sellers, I'd love the opportunity to chat with you, see if I can help you in some way, shape, or form, maybe even earn your business. My number is 843, which you can call or text, 843-800-0065. That's 843-800-0065. You can check out our website, listingsincharleston.com. That's listingsincharleston.com. You can also email me if that's what you prefer. My email address is Brian, that's BRIAN, at brianbeattyteam.com. So this is the show, if you're just joining us, where we're talking about what we think is going to happen next year in the world of real estate, specifically what's going to happen here in Charleston. And so as somebody that's been selling real estate for 20 years, done about 1,500 transactions, a little more, I provide you guys with honest opinion and insight as somebody that's experienced and in this market every day. The goal is to educate my listeners, right? To inform you on the things that are actually happening and separating fact from fiction, right? There's a lot of buzz and a lot of misinformation in this industry. And I understand the irony, by the way, in that comment as somebody on air. But I really just like with my clients, right? We are truthful. We are honest. We have integrity. We tell people what to expect and what's going to happen before it happens. We don't really sugarcoat many things because you guys need to make informed decisions, right? And a lot of that starts before the process even starts with regard to things like, do I prep my home for sale, or is it still the kind of market where buyers are going to buy it in any condition and pay top dollar? If I do decide to fix things up, what should I fix up? If I'm going to buy something, does it make sense to look at off-market opportunities, right? Is there a good deal to be had for something that's not publicly available? How do I find them? Right? There's a lot of questions that a lot of people are asking right now, but for the sake of just making some more momentum here in this list that I've gathered, the next thing I want to talk about is the fact that home prices, where are they actually headed, right? A lot of people want to know what's going on with home prices. Are we going to continue to see this massive amount of appreciation, or have they flatlined? Or are they going to start going down, right? This is another area where expectations, I think, tend to get a little overheated, right? Most forecasts are pointing to a very modest price growth in 2026. You look at something like Redfin's saying that's going to be about a 1% increase nationally. Zillow, they're up 1.2. National Association of Realtors, they're up at 4. And historically, they kind of tend to be a little more optimistic than everyone else. The reason prices aren't expected to jump is pretty simple. Mortgage rates are still relatively high. Prices are already elevated, and the economy is slowing just enough to keep demand in check. But here's the important shift, right? and this is a big one. For the first time since the aftermath of the financial crisis, wages are expected to grow faster than home prices for a sustained period of time. That's the reset we've been talking about. And the big key word that we've had on this show for years is affordability, because everything has kind of been revolving around affordability. Of course, the other issue is supply, which we'll get to in a minute. But so even though prices might inch up a little, and even if mortgage rates only come down slightly from where they were at the end of, at the end of this year, monthly housing payments should start rising slower or more slowly than incomes. That's how affordability improves, not through a crash, but through time. Right now, normally when demand like this slows, you'd expect prices to fall, right? But we don't think that's going to happen next year. And here's why. Sellers are pulling back too. Most homeowners today, they've got a ton of equity. I think remember the exact number, but it's I think a little under $200,000. It's like $187,000 is the median amount of equity that each homeowner has in this country, which is astounding, right? Most homeowners today, they have a lot of equity, very low delinquency rates, right? We're not seeing a lot of foreclosures and banks taking back properties, fairly solid credit. They're not under pressure to sell. Now, if the market isn't great, they can just wait. That's a huge difference from past downturns where the same economic forces that hurt buyers forced sellers into distressed sales, right? Well, today, I think the pressure is mostly on buyers, not homeowners. And yes, improving affordability will bring some buyers back off the sidelines. But for a lot of people, especially Gen Z, young families, first-time home buyers, housing is still going to feel expensive, right? I think a lot of folks will continue to make non-traditional choices, roommates, multi-generational living, delaying home ownership, all of it, just to make the numbers work. So again, it's not a dramatic moment. This is just not one of those dramatic moment times, I think, in our market. It's a slow recalibration. And understanding that helps you make some smarter choices instead of just waiting for something that probably isn't going to happen, right? The next thing I want to mention, the next prediction that I want to make is that home sales will increase. If you look back to 2020, right? There was a point in time in 2020 where we were still kind of unsure what was going to happen in the market, right? Whole COVID-19 thing. We did 5.6 million transactions nationally in 2020. In 2021, it jumped up to 6.1 million. 2022, 5 million. And then 2023, 24, this year, we're all going to be the same at 4.1 million, right? 4.1 million. That's 2 million less transactions, a third less people moving than just a few years ago. And so what they're saying is, well, next year, it's going to be 4.2 million, right? We're going to see a little rise in home sales of about 3%, right? Which, again, puts us at around 4.2 million homes sold. And that's progress, but it's not some massive surge. Where you really feel improvement, I think, is in the spring buying season. Think about it this way. In the spring of this year, mortgage rates were hovering around almost 7%. If rates were closer to like 6.3% this coming spring, that's enough change in the math for a lot of buyers, especially the ones who've been sitting on the fence, right? But again, it's a modest shift. Sales are only going to tick up slightly because affordability improved slightly, right? It's not across the board for everybody. A lot of would-be buyers are still going to be priced out. So yes, activity improves, but it improves carefully, gradually. It's not a stampede. The floodgates aren't going to open. In my opinion, it's just a slow return of confidence in the market, one buyer at a time. All right. Now, for those of you that maybe know somebody that has been trying to get into home ownership and they've just been stuck renting because they can't afford it and they can't bridge the gap and save enough money for their down payment and closing costs, or whatever the reason is why they haven't been able to buy a home. Maybe they just literally don't have enough income to afford what they want to buy, where they want to buy it. Well, another prediction, I think, is that rents are going to rise next year as supply falls. So let's kind of shift over to the rental side of the market for a moment, because that story's changing too. I mean, next year, apartment demand is expected to rise at the same time that supply starts to fall. And obviously, when those two things collide, rents usually move higher, right? Nationally, the expectation is that rent's about 2 or 3% higher than it will be at the end of this year, right? So not a huge increase, basically right in line with inflation. But the reason's pretty straightforward. Apartment construction, right? It's cooled off significantly since that big building boom we saw in 2021, 2022. Then we had prices skyrocket. We had land skyrocket. We had materials skyrocket. We had labor skyrocket. You name it, we had it, right? So that just means fewer units coming online and more competition for the apartments and properties for rent that are available. At the same time, a lot of people who might have bought a home in the past few years are staying renters longer, right? Down payments are still expensive. Monthly mortgage payments are still high. And for, a lot of households, renting simply feels like the safer option right now. And to an extent, I understand that, but it's not going to be uniform everywhere. There are going to be certain markets like South Florida and parts of, Southern California that might have like stricter immigration enforcement that could slow down rental demand and, put a ceiling on rent increases. I mean, there's a lot going on there. But in most metro markets, the rental market tightens, right? And that's something both renters and investors, I think, need to be paying attention to. The last prediction that I will make before we take another break is that because of these high housing costs, households are going to continue to be changed, reshaped, right? And even with affordability slowly improving, it's probably not enough to suddenly boost home ownership for young families. I mean, if you look at the stats, a healthy real estate market, about 40% of the transactions come from first-time home buyers. Right now, we're sitting at 24%, right? The median age of the first-time home buyer is 38 years old, right? For a lot of people, they have missed a decade plus of appreciation in their property, in wealth that is gained over time through ownership of real estate, all right? And so you've got Gen Z and millennial home ownership rates that basically stalled out last year. And there's no real sign that that's changing anytime soon. Instead, I think what's changing is how households are being formed, right? We're moving further away from that traditional nuclear family setup. More adult kids are living with their parents. And in some cases, parents are moving in with their kids, right? We're seeing more friends team up to buy homes together, which is kind of interesting. I always thought that was going to be either a really good idea or a really bad idea. It's like the old saying, give me a big ship, give me a fast ship, but don't give me a partnership, right? So we're seeing more friends team up and buy homes. They're pooling resources. They're putting like prenup style agreements together in place so that everyone knows where they stand with regard to the ownership or disposition of the house. Now the share of young adults living with their parents has come down, by the way, from pandemic highs, but I mean, it's still historically high. It's still historically elevated. As of about the middle of this year, about 6% of Americans who were struggling to afford housing moved back in with their parents, and another 6% moved in with roommates. And those numbers are expected to creep even higher next year. So you've got high housing costs that are also changing family decisions in other ways, like families are getting smaller. The fertility rate in our country has been trending down for several years, and that expectation continues. Right? So when housing takes up a bigger chunk of the budget, people delay and rethink major life decisions. There are all these reasons to buy or sell a home that begin with the letter D, right? Like death, divorce, diamonds, diapers, degree. There's a bunch of others. But what's interesting, though, is how homeowners are adapting, right? Instead of moving, a lot of families are just choosing to renovate and make their homes work for maybe multiple generations, right? You've got your parents that move in with you. Maybe you've got your son and his wife and their young kids that are moving in with you until they can get settled. In a recent survey of home renovation professionals, the most commonly cited design trend for 2026 was multi-generational living, right? Things like mother-in-law suites, ADUs, additional dwelling units over garages and things like that. So it's becoming less of a niche idea and more of a practical solution in today's housing market. And a lot of people are looking at their home and they're saying, well, you know what? I think we have the ability to make this work. I love my payment. I love my interest rate. We got a ton of equity. Why don't we just pull some of it out and make some of these changes and stay? Again, that doesn't really help the supply issue. And so that's why prices are going to more than likely inch up again next year. Not by any substantial measure, but I don't think that we're in line for a crash is what I'm going to say. And so I've got a few more predictions that I want to get through, but we're going to take a break. If you're listening, if you're thinking, I would love to have a conversation with Brian and just put some ideas together, maybe just the border of the puzzle, right? And we can kind of fill it in over time as we go. And as, your sense of urgency or timing becomes a little more appropriate. But if you at least want to kind of get some foundational elements to this decision-making process together, let's have a conversation. My number is 843-800-0065. That's 843-800-0065. Or you can check out our website, listingsincharleston.com. That's listingsincharleston.com. We are talking about what's going to happen in this crazy real estate market next year. If you're just joining us, we've gotten through about half of the predictions on this list that I've curated based on my own experience as somebody that's been selling real estate here in Charleston for the past 20 years, about 1,500 transactions. Still loving the job, still helping everyday buyers and sellers with their transaction, with investments, with management, with development. We kind of wear a lot of hats and we're in a lot of different places at the same time, but we love the opportunity to help anybody we can, even if it's just by providing some information or a resource or a contact. So again, my contact information, if you want to reach out to me, you're thinking of hiring a real estate agent or you just need some help with no strings attached, happy to do that too. My number, 843-800-0065, 843-800-0065. That comes straight to me, by the way. You can call or text that number. Or listingsincharleston.com. That's listingsincharleston.com. So let's keep going with this list. I'm only halfway through and we're halfway through the show. The next prediction, which is an interesting one. One thing that has become crystal clear, especially after the November election, is that housing costs are at the very top of voters' priority list, right? And that's obviously particularly true for younger voters and families and people that want to get into home ownership. It's not just about home prices and mortgage rates anymore. The total cost of owning a home keeps climbing. Insurance premiums have exploded in a lot of markets. Look at what's happened to us, and there's real concern that utility costs are headed higher too, especially as large, like AI-driven data centers put more strain on power grids, which is something maybe a lot of people haven't thought about. But because of that pressure, you're going to see more political attention on housing, I think, than we have seen in years. I know a lot of people have wanted it, but it also, it's like it kind of gets swept under the rug, right, at times. Well, I think we're at a point in time now where, there's obviously talk that Trump could declare a national housing emergency as a way to open up more tools to, help Americans afford homes. And, across the board, left, right, and center, you're going to see more proposals, I think, aimed at easing this affordability crunch. And so I mentioned earlier the YIMBY movement, which I don't know if a lot of folks know what that is, but it stands for Yes in My Backyard. That idea is picking up support across party lines because it focuses on one thing we clearly don't have enough of, and that is supply. There's already bipartisan legislation that exists and is floating around, like the Yes in My Backyard Act or the Build More Housing Near Transit Act. And they're moving through the process, obviously. But you're going to see, I think, also a lot more zoning reform. And this is interesting for us because there are a lot of areas of Charleston where, man, it would be great if I could build a detached garage and put an additional dwelling unit above it. But you also have a bunch of homes that are in property owners associations with HOAs that have something called an ARB, Architectural Review Board. And they have covenants and restrictions and bylaws telling you what you can and can't do. So there's talk about zoning reform, which would make things really interesting. It would make it easier to build things like an apartment over a garage or home additions. And it's not just, cities. You look at across the board. I mean, there's states that are looking harder at the housing shortage in rural areas than places like us. So I think some of these policies, might help. Things like, 50-year mortgages. We did a show on that a few weeks ago. It sounds appealing if you're, desperate, in my opinion. But they don't actually make homes cheaper. They just stretch the pain out longer, right? We talked about that too. And that's the part people that, they don't always want to hear that. There's no instant fix. Housing costs exploded much faster than wages did during the pandemic. And while wages are now finally expected to start kind of turning the corner and outpacing home prices next year, it's likely going to take several years for the market to feel anything close to normal again. It kind of feels a little bit normal now, but in a little bit more of an extreme sense, because people are still trying to figure out like what's going on, like where do we stand as a market? So this isn't about one policy, one election, one person, or one big announcement. It's about time and understanding that reality helps people make smarter decisions instead of chasing quick fixes that don't really solve the problem. I also think because of what we will see in a slight reduction in mortgage rates next year, I think you're going to see more people refi and remodel. I mean, I think that's going to be a pretty big trend for next year. They're expecting mortgage refinance activity to jump by about 30% next year, to the tune of about $670 billion worth of mortgages refinanced. And the reason is, it's pretty straightforward, right? About 1 in 5 homeowners still have a mortgage rate that is north of 6%. And a lot of people who bought and refinanced recently at higher rates are just waiting for the chance to lower their monthly payments. So as rates drift down, even modestly, you're going to see a wave of homeowners finally pull the trigger and refinance. And, because we have so much equity, I looked it up during the break, we have $181,000 on average in untapped equity in the term of homeownership per person or per household in our country, which is amazing, right? And that gives people options, right? Things like home equity line of credit or cash out refinance to pay for remodels and additions and upgrades. And for a lot of, households, renovating the home they already have makes a lot more sense than going out and buying a new one. It's often less expensive, it's less stressful, and it lets them adapt their home to their current needs, obviously, instead of just starting over somewhere else, right? So again, it's not about flipping houses or chasing the next deal. It's about people making practical decisions in a market that's still adjusting, right? There's a lot of talk about where the hot and cold spots in our country are going to be next year. I'll just clue you guys in and let you know that we're not on either list, okay? For the first time in a while, which, I don't know. On one hand, look, I love all the people that are moving here because it keeps me in business. On the other hand, I hate sitting my butt in traffic for a lot longer than I should. So, it's a double-edged sword, kind of. But, man, you look at some of these markets that really took off in the COVID era of our real estate market several years ago. Places like Nashville, places like Florida, areas like Texas, San Antonio and Austin. And I mean, Florida's in rough shape right now. So I think you're going to see homes that are going to languish on the market, right, due to natural disasters, surging insurance costs. And, a lot of people that live there are remote workers that have the ability to move anywhere. And so they're probably just saying like, look, we're out of here. I mean, we thought it was going to be great, but a lot of folks that go from the Northeast that then move to Florida, that then settle somewhere around us. We have a specific term for that here in Charleston. We call them a halfback. I don't think it's derogatory. It might, I don't know. I don't think it is. But it just means that they move from like New York to Florida and then come halfway back. That's all it means. So what we might see actually is even further pressure on our local inventory as people move away from those areas, as people migrate up from Florida. But let's be honest, even here in Charleston, our insurance, our taxes, our utilities, just our overall cost of ownership is significantly higher than it was a few years ago. And so I think climate change, which is my next prediction, will go hyper local. Like one thing that doesn't get talked about enough is how climate is starting to influence where and how people live, right? And I'm not about to go on some sort of crazy global warming tangent, don't worry. But I mean, if you really think about it from a practical perspective, as hurricanes and wildfires and other, extreme weather events have become more frequent and more intense over the past several years, right? Climate is becoming a real factor in housing decisions. But for most people, that doesn't mean packing up and, moving halfway across the country. You're not seeing mass migrations from, coastal Florida to the Midwest. What you're seeing, I think, is something a little more subtle. It's people that are getting a lot more cautious about where they build, where they buy, and whether they hang on to certain properties, especially in areas that are considered, higher risk. We have a lot of folks that own second homes and investment property here in Charleston. Maybe they're thinking that now is a good time to divest of those assets. And so I think it hits us pretty close to home. I mean, insurance costs have skyrocketed. I've told you on this show what's happened with my own insurance with some of my properties. Flood insurance, wind and hail, even basic homeowners policies, they're all up. And so for a lot of homeowners, especially retirees or people on fixed income, these insurance increases are stacking on top of rising property taxes, higher utilities, and an overall just higher cost of living. And so, I talk to homeowners here in Charleston all the time who say things like, I can afford my mortgage just fine. It's everything else that's getting me, right? When your insurance premiums jump by thousands of dollars a year, that definitely changes the math, and it changes it pretty quickly. And because of that, some people are choosing to, avoid certain flood zones or flood zones altogether. Well, good luck doing that in Charleston. It's pretty hard to do unless you're willing to go to like more Charleston, Somerville. But if you want to be actually in a coastal environment, close access to the beach, water, all the things that make Charleston really cool, in my opinion, one of the things that makes it really cool, then yeah, you're gonna have to shell out some good money for that location. And some, longtime residents are quietly kind of asking the question of like, does it still make sense for me to be here? Like, is this sustainable? So climate isn't, it's not just an environmental issue. It's an affordability issue for folks that are looking at either buying or staying in the homes that they have. And it's in markets like Charleston, and it's becoming one of the more important factors that's kind of shaping housing decisions moving forward. So we're going to take one more break. I've got a few more things to say, so stick around for the last few minutes of the Brian Beatty Real Estate Show right here on the Big Talker 1250 WTMA and WTMA.com. And just as a reminder, if you want to reach out to me, you want to work with a competent, experienced real estate agent that really understands this market and how to win in it, then give me a call, 843-800-0065, 843-800-0065, or check out our website, listingsincharleston.com. Thank you so much to those of you that listen to this program. I know a lot of you are regular listeners, and I do really appreciate that. And I appreciate those of you that reach out that we can help. Again, our number, if you want to reach out to us, if we can help in any way, whether it's engaging with you as a real estate agent or a property management company, or you're looking for investments, or if you just have simple questions, we're here to help. 843-800-0065, 843-800-0065, or listingsincharleston.com. So last quick prediction is that I think AI is going to become a little more helpful, but also a little more disruptive come next year. We've got generative AI that is increasingly being used by people to figure out where they should live. And for that, I think it's awesome. All right. I think it does do a good job of like general education. So instead of going online and like starting with a zip code, buyers might search for something like, hey, I want to see homes in this budget within a certain commute time from this location. That includes flood risk tolerance and school preferences and lifestyle priorities, and so on and so forth. And, they can generate areas and lists of homes in ways that most real estate based websites just don't have the functionality for. Or if you were to use those websites and use the functionality that's built in, it would take you the learning curve would be pretty steep for you to be able to know how to manipulate the search to that degree. So on one hand, I think that that kind of technology makes it easier to find homes with very specific niche features, but it also helps educate buyers about the process along the way. And I think that's where it becomes a double-edged sword, is because AI is great at giving general information. It can explain concepts, it can run scenarios, But what it still can't do, at least not well, is replace the judgment of a seasoned local real estate professional who understands how a specific neighborhood really lives, or what insurance costs look like, street to street, or how a deal is actually done in the real world. So I think AI can help you search smarter, but it doesn't replace experience. And in markets with as many variables as ours, quite honestly, that distinction matters more than ever. So the big question everyone's asking right now heading into next year is it finally a buyer's market, or is it still a seller's market? And this is where a lot of housing market predictions start to fall apart. I mean, on paper, the market looks more buyer friendly than it did a few years ago. That's certainly true. Homes are sitting longer. The average days on market is creeping up. And you look at data sources, not just from our local market, from across the country, and they're all kind of saying the same story, which is that sales and listings have mostly stalled out compared, of course, to the pandemic frenzy. And that sounds like a buyer's market, but the catch is it's not a buyer's market everywhere. Inventory is what really tells the real story. And yes, there are more homes for sale than there were at the absolute lows. But in many local markets, ours included, supply still hasn't recovered to where we were at pre-pandemic levels. I mean, in those areas, sellers don't have to chase buyers. Well-priced, move-in ready homes that are marketed well, that are represented by quality real estate agents that actually have a plan and a budget, right? A real true marketing plan to sell a house, that specific house to a specific set of buyers. Those are the ones that are winning. But in markets that are, overbuilt, the story's obviously a little different. Those homes are sitting longer. Sellers face more competition. If you're competing against builders, then they're able to manipulate interest rates in ways that you can't, or that won't make sense for you to do from a financial perspective. And this is why, national headlines, I think, are misleading. Two buyers shopping at the same time with same budgets are going to have two totally different experiences depending upon where they're looking, right? So I think that that disconnect, that fragmentation is likely going to define 2026 more than any single prediction. This isn't a market that tilts cleanly in one direction or the other. It's a market where local conditions, preparation, and flexibility matter more than trying to time the perfect moment. And that's really the takeaway as we head into next year. So if you're thinking about buying or selling or investing or even managing or having us manage a rental property, the smartest move isn't necessarily waiting for the headlines to turn positive. It's understanding your local market and having a clear plan. So if we can help you with that, we'd love the opportunity to earn your business. Our number, 843-800-0065. That's 843-800-0065 or listingsincharleston.com. You guys enjoy your holidays. Thanks for listening.